And good day, everybody, and thank you for joining us today. Well, summer is almost here. It's about 80 degrees here in Boston, and that means that you have almost made it to this June 30th. Yay! So today we're going to provide just a brief overview of what is in store for this fiscal year ending June 30th for states and local governments out there. Is there some, oh my gosh, stuff we have to deal with this year? Well, as we say annually, it really depends on your government. But just remember, the sun will come out tomorrow. So my name is Eric Berman. I'm a partner with Eide Bailey, and joining me today is Nathan Edelman, a partner in our Menlo Park California office. Nathan, why don't you introduce yourself?
Yeah, thank you. Good day, everybody. My name is Nathan Edelman. I am a governmental audit partner in the firm's Menlo Park, California office. So I'm in the Bay Area. Weather's a little cooler over here. I specialize in audits of state and local governments. Eric, kick us off.
Thank you very much, Nathan. And let's roll through the agenda today. We're probably not going to get through all of it, so don't worry. You're probably receiving a PDF of the handouts from as we speak. So first, perhaps a forgotten standard, GASB 91 on conduit debt. And for some of us, yeah, it'll be an issue. We'll then talk about public-private and public-public partnerships and availability payment arrangements, which may impact many of the governments that are out there. And we're then going to roll into everybody's favorite GASB 96 and then do a quick recap of GASB 99 that's going to impact it this year and next. Now, if we do have some time, we'll then introduce you to GASB statement numbers 100 and 101. And oh, by the way, I'm going to give you a present at some point this summer, GASB statement number 102 on certain risk disclosures. But we have a ton of content in this deck. And if we don't get to 100, 101, and 102, we're going to revisit these later this year just in case. So one of the things that we at Eide Bailey like to do during our webinars is to give you a sense of what the future may look like for each fiscal year in terms of a heat map, which is common if you do a risk assessment, which we encourage you to do. Now, this year, the big story out there is going to be GASB 96 for all sorts of governments. And I'm sure some of you are just waking up saying, hey, wait a second, it's June 12th. I gotta get going on GASB 96, and that's fine. But for some other governments, GASB 94 and 99, will have an impact. Now, due to the issues involving SBITAs that we talked about for many webinars over the past couple of years, there will likely be SBITAs found in the corner of your government for many years to come that may not have been found previously. Now, that's something we all have to realize, and that's why there's a little tail of GASB 96 out there. That's why it goes from red to yellow and so on. Now, looking out next year, not too tough to take other than gearing up for compensated absences of GASB 101 and GASB 102 on risk disclosures. Now, looking further out, the looming issue is what may be GASB 103, the Financial Reporting Model Project. Now, that date is a little fuzzy as it may move. And there's some language I looked at this morning on governmental funds, which may move that date a little bit. But as proposed, we may be looking at June 30, 2025 for the largest governments and their component units, a year later for all others. And then even further, what may be GASB 104 on non-financial assets, maybe in 2026. And as currently being discussed, there's just not much gap changes in the project as of yet, just for that GASB 104. Now, what may be 104, by the way. Now, for the youngsters in the crowd, looking even further out, like Nathan's age, looking even further out, the revenue and expense recognition project, that may be finalized in 2027. But again, we're not sure of what we're looking at in terms of implementation. We also have a project ongoing concern, uncertainties, and severe financial stress. That's a big deal. And knowing what's going on in places like Chester, Pennsylvania, and the fiscal cliff coming with the sunset of federal programs related to COVID funding, this project may be pretty timely for some. But again, we're also looking potentially in 2027. Now, final look, we have a brand new project you may not have heard about, and it's just starting up. The board is just starting discussions during the upcoming meeting here in June. And what they're doing is they're taking a look at the future of infrastructure reporting. For decades, there's been a simmering debate on whether a liability for deferred maintenance should be recognized, and should the modified approach be applicable for all, or should historical costs be the single standard for infrastructure? Now, that's going to give us a lot of content for future webinars, so we don't need to get there as of yet, but I'm just telling you it's coming up. And so with that, our first polling question. Okay, we're going to give you a little bit. Yeah, I mean, that infrastructure one out there, that could be a big deal. But again, we're talking years and years and years from now.
And remember, if you are here for CPE, please make sure you are answering these polling questions that you see on the screen.
Okay, let's give it a couple of more seconds.
And
I switched it for you, Mai. Okay, let's give it another 5 seconds.
Oh, you're already at the results.
Yeah.
They can't answer it anymore.
All right. Well, sorry about that. I was quick draw McGraw on that one. So, all right. So with that, thank you, everybody. All right, Nathan, take us quickly through GASB 91.
Yeah, thank you, Eric. So 91, conduit debt is important as it may change the way many borrowers report debt. GASB 91 replaces current standards that are nearly 30 years old and in fact a lot older. The current, the current standards were really just a GASB interpretation of existing standards that were originally issued in the 1940s. So what is conduit debt, or a CDO? CDOs require at least 3 parties. You have the issuer, the borrower or borrowers, and a debt holder or debt trustee that manages the funds on behalf of the bondholders and borrowers. Typically, the trustee is a corporate trust department in an investment institution. A major change is that borrowers and issuers are not in the same reporting entity. So we find this often with finance authorities for governments issuing debt. The debt is titled a CDO. Often the bonds are cross-collateralized or parity bonds. Cross-collateralization occurs when one bond series collateralizes another. If one bond defaults, the others fail in sort of a house of cards. So what is a parity bond? A parity bond refers to 2 or more bond issues with equal rights of payment or equal seniority to one another. In other words, a parity bond is an issued bond with equal rights to a claim as other bonds already issued. In this case, one bond may default, but then the bondholders can sue all the holders of the other bondholders for payment. So in CDOs, a corporate trust department receives the funds and manages the funds on behalf of the borrowers and the debt holders. Finally, if all is in place, the issuer only has a limited commitment to repay the debt, as it's really the borrower's responsibility. This limited commitment it's difficult to understand. An issuer's commitments associated with a conduit debt obligation can vary. An issuer's commitment with respect to the conduit debt obligation is limited. However, the issuer can extend an additional commitment or a voluntary commitment of its own resources. Under an additional commitment, the issuer agrees to support debt service payments only if the third-party obligor is or will be unable to do so. Examples of additional commitments by an issuer to support debt service payments, they include, but are not limited to, the following examples. You have A, extending a moral obligation pledge. B, extending an appropriation pledge. C, extending a financial guarantee. And D, pledging its own property, revenue, or other assets as security. Under a voluntary commitment, an issuer does not make an additional commitment, but on a voluntary basis decides to make a debt service payment or request an appropriation for a debt service payment if the third party is or will be unable to do so. GASB 91 focuses on form versus substance. You may be familiar with terms certificates of participation or revenue pledges or limited obligation bonds. The terms do not matter as much as the substance of the transaction. If the bonds meet the definition of a CDO, then they are a CDO, and as such, guess what? If it is a CDO, the issuer does not report the bond issuance unless they have some form of non-exchange financial guarantee. That is different than today. So today, typically the issuer reports, and that is important for some governments that are parties to CDOs that meet the definition and have never reported this debt. So where is this headed? If the CDO is in place, again, if your government is an issuer that signs the bonds, then the CDO is not reported unless it is committed to pay debt service. Again, the obligors, hospitals, colleges, municipalities, and so on, the obligors report the debt. As an issuer, your government may have a voluntary commitment, but the reporting is also limited. So be careful of the labels and the jargon. Remember the substance of the transaction. Accounting and financial reporting also depend on facts and circumstances. CDOs should be financing capital assets. In some cases, the asset reverts to the issuer. In some cases, they are shared. The accounting may vary. Here are 3 scenarios that you may want to review. And notice the differences and the resulting accounting. If you have issued CDOs, do not report these as leases, nor as a liability, nor as a receivable. So now, as we talked in one of our last webinars, if the arrangement does fit the definition of a service concession arrangement, it may fall under GASB 94. So be careful of that one. For the notes, only disclose in general terms what is going on and if there is a non-exchange financial guarantee in place. For bond issuers such as state revolving funds and infrastructure banks that no longer present the debt information related to CDOs, there will need to be an information exchange between issuers and the obligors that may not be in place now. If you are one of these entities, you may want to start thinking about the internal controls over reporting and consider what is being done by the statewide defined benefit pension plans and their participants, because the information exchange between those entities may be like what is needed here. If there is a liability recognized at the issuer, then there are additional disclosures exactly the same as the disclosures required for non-exchange financial guarantees. So with that, let's get to our second polling question. This is just a temperature check.
Okay, and for those who missed the first poll, please make sure you answer you answer all the other polls that you see appear on your screen, and also just put in the Q&A if you did miss it, and I can give you the email address to send an email in regards to that missed poll. So we have, and if you have any issues seeing the polling question, also place that in the Q&A box and I can assist you.
Okay. We'll
Okay,
give
and
that a few moments.
it looks like there is a question in the Q&A box.
What do we got?
There's one at the way bottom, that first one.
What was the only thing I'm seeing is what was the first? Was this the first poll? No, that's the second one. Let's see. Okay.
If you scroll down a bit, there's one.
Yeah.
Can you provide her?
Yeah. All right. Let's table the one on GASB 99. All right. And again, I apologize for hitting the thing. Can you provide a real life example of conduit debt? Yes. For example, you have a state health and educational finance authority that indirectly pledges the debt of the state and helps finance hospital expansion, college, university expansion, and so on. That's a very, very common example of that. Certain state revolving funds also have conduit debt. It really depends on the facts and circumstances of each bond issuance. All right.
All right. We can leave this up for a few more seconds. Again, if you're here for CPE, please make sure you're answering this polls. And also, if you missed the first one, make sure you answer this poll.
Come on. Well, we're at 89%, so we should probably get moving. I wanted to thank you, Nathan.
All right. Well, yeah. All right. Well, Eric, let's talk about PPPs.
All right. Let's see how we're doing. Still unsure. Well, certainly, if you want to reach out to us on conduit debt, by all means. But it is pretty common out there. All right. So thank you, Nathan, again for what you're doing. Now, some of us may have forgotten also about GASB 94, but it may impact many of us. I was talking with the state earlier this morning about their progress on GASB 94. Especially it might impact us when we consider that we may outsource the management of some of our capital assets and related programs. And this particular state I was talking to outsources things like beach management, ski area management, skating rinks, golf courses, hotels, things like that. And so, yeah, it does impact. It's probably easiest to think about public-private partnerships or P3s and examples. So let's start with the last one first. That would be the APAs, and those are payments based on milestones. Again, it's mainly for design, build, operating systems. P3s, which could be public or private operations, are when governments outsource things like tolls. California, Colorado, Virginia, and other states, they have toll roads or express lanes that are P3s. And if the capital assets are managed by another government, though, it is a public-public partnership, and that does occur, especially in things like data centers and so on. But that other government must be totally separate from the primary government. Now, SCAs are common. They're mainly municipal golf courses, municipal utilities like water and sewer systems. Again, these have been recognized since Statement 60, but now the gap needs to align to what is in what was originally proposed in GASB 87 and became standard in GASB 87. And that's one of the more important decision points in deciding as to whether or not something applies under GASB 94 or 87. So let's dive in a little further. In most cases, if your government has a PPP, your government is going to be a transferor. Now, some signatory authority, they should be signing the contract because it usually has a lot of zeros in it. And that means with commas and zeros, because these are pretty big dollar amounts. It's not a sale. The title does not transfer, meaning there is a time element we must consider. Now, usually it does involve infrastructure or buildings if the government wants to have a developer or some other entity operate the facility. But I'll get to that shortly. We got to have some element of consideration that resembles a market value exchange or some exchange that'll derive a market value, such as a permit or an assumption of debt. Remember the discussion of exchange and exchange like of what we did when we did webinars on the leases. Now, the assets involved with the transaction can be something that is already built and operational, or it may be constructed or acquired by the operator, or it may be built but needs improvement. As an example, let's say, and this is a real example, a state office building is full of asbestos and it needs to be rehabbed. An operator was engaged to design, rebuild, and operate the building with the provision that 50% of the space is for state agencies and 50% of the space is for rental housing for state office workers. And that's a very real example. The operator receives the rent and keeps 90% of the rents, and the other 10% is sent to the state because, hey, they're tenants in half the building. The agreement is for 40 years, and that is likely a service concession arrangement and a P3 due to the control aspect of the state. Now, the operator in the state building they're a private developer. However, another government may operate the building. Now, let's assume an economic development entity in the city where the state office building is located is the operator. Now, the entity is legally separate from the city and the state, and it's not part of the state's reporting entity. The entity is the operator and is a government. Now, more commonly, banks, not-for-profit entities, insurance companies, other for-profit entities could be operators. They may be engaged to design, build, finance, and operate the P3 in addition to overall management. Now, just like the operator of the state office building, they're going to be compensated from third parties. And in this case, tenants for 50% of the building, but they're subject to controls. And, I had a conversation last week with somebody who was thinking of doing that with unused space in state office buildings to solve the affordable housing crisis. That's not a bad idea if you can make it economically feasible, of course. As you've heard, we potentially have more than 12 facilities in scope, water, sewer, buildings, convention centers, dams, parking, energy facilities, especially with the new energy credits that started on January 1st from the Inflation Reduction Act. That's beyond the scope of today, but we're going to be having a roundtable on energy credits coming up in September. Airport terminals, all of those might be P3s. In the work that I've managed, I've found public golf courses, skating rinks, pools, cafeterias at public hospitals, dorms, bookstores, even a fish hatchery that are potentially in scope for a P3. There are likely others, and they're going to increase as governments look for more creative financing, especially, again, with the Infrastructure Investment and Jobs Act funding from the federal government, as well as the Inflation Reduction Act. And again, energy credits in the Inflation Reduction Act, which was not chopped by the debt deal, by the way, this is prime territory for public-private partnerships. And there are some postings on our website on energy credits. And again, we're going to be having a roundtable on this coming up later on this year. And just so you know, Eide Bailey is the biggest firm out there involved with these credits because we have a one-stop shop complete with tax professionals, engineers, and consultants available for your state and local government. So let's look at further examples. For APAs, it's similar to a lessee arrangement for your government, but your government only pays based on certain milestones. For other P3s, your government may or may not have a service concession arrangement involving infrastructure. And again, there may be a design, build, operate agreement. For service concession arrangements, again, we've been reporting these since Statement 60 since 2010. And if you don't know what they are, we can have a separate sidebar conversation with you. Now, those standards have been cut and paste right into GASB 94. So hopefully it's not a big leap of faith for you. Now, the P3 framework, it's based on GASB 87, but one huge problem we got, we could have a fallback to GASB 87. If the underlying asset does not need to be acquired or constructed, improvements are not necessary, the agreement's not a service concession arrangement, meaning the operator can charge whatever they want to, guess what, folks? We're back at a lease. And this means that if this contract was not recognized when you implemented GASB 87, you got a further balance adjustment that may be coming in the future. But again, we knew that sort of going in. Now, if you're still lost on GASB 94, GASB staff put together this graphic, and again, bookmark it, circle it, whatever you can do on the screen. This is something you want to save. You start with the premise that the contract either meets the definition of the SCA or it doesn't. And if it is an SCA, then follow GASB 94. If it's not an SCA, then if the assets are new or improved, follow 94. But if they're plain old assets and no improvements are needed, then guess what, folks? You're back at a plain old lease, which we talked about for the past however many years. Just follow the yellow column and you'll be surprised. Look at the bottom right-hand corner and you're back at a lease. And that's why these things are really, really closely related to leases, except for the control aspect. And with that, let's get to another polling question. While I take a swig of water. Okay, what do we think here? And while you got that, I'm going to take a look at the questions. We got a bunch of questions that are out there. Okay. My friend from South Dakota, we have third-party management groups that run golf courses, entertainment facilities. They are paid based off a management arrangement, percentage of net income, and not actual third-party fees. With this type of arrangement, what type of arrangement would these be? Well, those could be P3s. However, since the payment is purely variable, the only payment in would be inflows. And so it may just be a contractual relationship. But, the golf courses and skating rinks and pools I've looked at have been totally variable. And so it might just be a contractual relationship. The question then becomes, hey, is there a bunch of control going on in that relationship? And in which case it would be in scope for the P3s. To be classified as a P3, does the private entity need to have a share of the profits, earnings, or just paying it? That's all depending on the contract. And so it's similar to the first question I just answered. Can we say that a P3 is a contract where we have some land that can only be used for storage and we transfer it to a private entity to run that storage unit? That could very well be a lease. And so that contract needs to be analyzed. So that's a good question, Claudia. All right, how are we doing in the poll, Mai?
All right, looks like we need a few more seconds for everyone to answer this question. Everyone, this is polling question number 3. So if I sent messages out to people who missed the first one, just keep answering the polling questions as you see them appear. And also for the minutes to watch requirement, with this being a 2-hour webinar, that should not say 50 minutes. So that's being worked on as well on the back end. So just make sure you're sending out you're answering the polling questions on your screen and not in the Q&A box. If you did miss a polling question, put that in the Q&A box, and I will send you an email to send that issued to, so we can ensure you get your credit. All right, and we will keep this up for a few more moments, and then we will continue.
Yeah.
There is an. Do you see the Q&A questions on your end? We have a few more.
Yes. Yeah, there was another on conduit debt. That one might not be conduit debt, but we'd have to see the person asked is conduit if I get a contract for VoIP phones for 5 years and the company providing the phones has us pay a different company that they borrowed the money from to pay the phone, so I'm not paying the company I made the agreement with. That is a funky arrangement. I'd have to probably see that contract. It might not be conduit debt. It might be a three-party contract. Let's see. All right. Yeah, and then the original question on 99. All right, Maya, we got to kind of move on here.
Alrighty. There we go.
And okay, looks like the majority rules, and they do have it. The answer is A, and it is due to the approval process for the toll rate increases from the state. It is a service concession arrangement, and it would be probably a P3. And it's because, there's a bunch of oversight that's going on there. And so hopefully you get a feel, for what we're really talking about with P3s. Okay. Let's spend some time on the framework for transfer governments with P3s. The elements you should see over the next few minutes, they should look pretty familiar because they're based on lessor accounting that we talked about over the past few years with GASB 87. Now, governments that are transferors, they're going to recognize receivables just like lessors, but there's a possibility for a second receivable out there if the asset is purchased or constructed. And just like in leases, the underlying asset, it's not derecognized as it's not sold. And if there is a transfer of an asset, that results in different accounting. And if there are legal or other initial direct costs in contracting, those are period costs and they're expensed. Now, transferors, they're going to measure the receivable for the installment payments using the present value of the P3 payments during the non-cancelable term. Guess what, folks? That's lessor accounting. Remember, though, like any other receivable, we got to reduce the receivable amount for any uncollectible amounts. Now, just like a lease, we need to consider fixed payments, variable payments that depend on an index or rate, such as CPI, variable payments that are fixed in substance, such as minimums or maximums, residual value guarantees that are fixed in substance. But we got to be careful, though. Many of these agreements also have revenue sharing options, which is what somebody asked in the chat. If variable payments are based on the future performance of the operator, usage of the underlying P3 assets, such as vehicles per hour on a toll road, or other variable factors other than an index or rate, those are variable amounts that are not included in the measurement of the receivable for the installment payments. Instead, those are inflows of resources, for example, revenue, in the period to which those payments relate. But if there's a minimum or a maximum amount, those minimums are fixed in substance, and they are included in the measurement of the receivable. Now, if there's revenue sharing, only the portion of the shared revenue that is earned is recognized. And I think that goes to the other person's question. And just like in leases, we need to calculate the non-cancelable term. And if your life has been inundated by leases, you've seen this before. Now, for the government that is a transferor, that term of the P3, that should look familiar. And I'm not going to read what's on the screen because it's basically the same exact thing as your lease calculation if you happen to be a lessor. And you sum those periods up, and that's your P3 term. And if both parties have an option to terminate without permission, those are excluded as the probability it's not going to be known. Now, just like leases, don't include those budgetary fiscal funding clauses unless they're reasonably certain to be exercised. But there's so many dollars involved with these. Fiscal funding almost never comes into consideration. But these agreements again have high dollar values and they're very visible politically, and it's going to be pretty difficult to cancel them. Now, if any of the options change from what's predicted, we have a modification just like a lease. So guess what? This is the same calculation that a lessor uses in a lease, and again, it's deja vu all over again. After all, a transferor is doing the exact same thing a lessor is. Temporary use of a non-financial asset in exchange for compensation. In P3s, though, it would make economic nonsense to do a short-term P3, as most of the underlying assets are long-lived non-financial assets. So the key really is calculating that term. So let's talk a bit about those predictions really quick. How do you recognize them? Well, options may be involved with past practice or integration into the operations of the government. So, for example, if a water treatment plant is the operation of the government and a private entity is operating the plant, like American Water or something like that, chances are the government is not going to terminate the contract anytime soon, as the water utility quickly turns off the spigot. And you got to need a new treatment plant, and that's not easily done. So for transferors, dog ear this page. Upon implementation or agreement, that debit is going to be a P3 receivable, and a credit is deferred inflow of resources as long as the underlying asset exists. You're going to continue to recognize that underlying asset as your government still owns it. And a further asset may be recognized when placed into service if there are improvements to that asset. Now, due to this additional asset, your deferred inflow may not equal this underlying balance. If there is new construction or improvements that are made to the operator of the P3, depending on if the contract's an SEA, now remember that definition, then you got to add that capital asset at acquisition value, and that's going to be as a debit. The deferred inflow of resources calculation will be slightly different, and again, the constructed or purchased asset is measured at acquisition value. Now, if we don't have an SEA, meaning we don't have control over those fees or charge setting process, and we have a newer purchased asset, then we recognize the receivable when the new or purchased asset is placed into service. And that receivable is measured at acquisition value as of the date of transfer. And that could be decades from now. So just be aware, and again, dog ear this page. So, okay, let's talk about the operator side. And I haven't found too many governmental operators out there as of yet, but there probably are some. They're a little tricky. In addition to the installment payments to the transferor at present value and the right to use asset, the debits and credits are based on whether or not we got a service concession arrangement. And if we don't have a service concession arrangement, but we have an asset purchased or constructed, or do we have an ultimate transfer after being placed into operation? If we got an SCA, we got a liability at acquisition value, along with the liability and right to use asset. Guess what, folks? You're just like a lease. If we don't have an SCA, but we got a new asset, we got a liability for the underlying P3 at acquisition value, and we got a liability for any additional installment payments. Now, if the ownership transfers, remember our bridge, but we have a liability and a deferred outflow at acquisition value, but we're not going to fully receive title to that bridge until however many decades from now. And we got an amortization that's going to go on until that date occurs. Now, I use the phrase acquisition value, and that is confusing jargon. Unfortunately, it is GAAP. It's not quite cost because it may involve assumption of debt or at a future date, which is in the case of a bridge. It's an entry price, but it's aligned to what would be paid rather than what is due to the potential of that future date. In our case, let's say in our polling question, it's what will be paid to acquire the bridge 30 years from now. We're not being forced to do it except for this contractual arrangement. So it is an orderly transaction. Out of the ordinary transactions are going on currently with things like, well, over in Nathan's neck of the woods in Menlo Park, you got Silicon Valley Bank. Bankruptcy is not orderly. We have an orderly transaction at a date of acquisition. And again, our bridge is 30 years from now. It is most often used for donated capital assets, art, and so on, which involve future dates, usually when someone passes away. And so, again, acquisition value has been out there for a long time. It's just we may not realize it. Now, armed with that knowledge, what are our debits and credits for transferors? Again, we got 3 potential outcomes all on one sheet. Dog ear this one. We got an existing asset, which is easiest. It's just like being a lessee. And our debit is to right to use assets, and our credit is for installment payments, if any. Now, some of these contracts may be prepaid. Now, if we have a newly purchased or constructed asset, the debits and credits will differ if we have an SCA. If we do have an SCA, the same debits and credits occur as with an existing asset. But if we don't have an SCA, the asset will be at the operator until it transfers. We then have a second liability for the acquisition value, along with deferred outflows of resources, and that's at a future date of transfer. But we have this other mongrel type of arrangement that's out there. APAs are arrangements in which a government compensates an operator. So again, we're the government, we're paying an operator for services including design, construct, finance, maintain, operate a non-financial asset for a period in an exchange or an exchange-like transaction. And this could result in a transfer of assets or just an outflow of resources. The most common type of APA is for a toll road agreement for variable rate tolls based on the number of vehicles in the non-toll lanes, with a Department of Transportation receiving a portion of those variable rates. And that's what is common on the East Coast. APAs will be really common as the Infrastructure Act really gets full boat. As an aspect of the APA type of arrangement is that payments only start when the underlying asset is in operation. This milestone is usually pretty well defined in the agreement. After all, if no payments arrive and the entity that is doing the design, build, operating, maintaining the road or bridge is responsible, then that entity may have invested millions or billions of dollars into the project, and they kind of want their money back. Typical milestones include physical condition at a certain level, opening of lanes, opening of facilities such as rest areas, or some other type of performance. Now, the effective date in transition are just like what occurred with GASB 87, but 1 year later. And if you got these arrangements, they're going to be material. And due diligence is really important. And if you need help, just ask. And with that, here's another polling question. And I'm going to mute for a second. Hold on.
All right, everyone, please make sure you answer this polling question as well. And it has come to my attention that the CPE requirements on your side is not reflecting what exactly should be. So with this being a 2-hour webinar, you should stay on for at least 110 minutes and answer 7 polling questions. So make sure you hit every single polling question that you see appear. And again, if you do miss one, let us know in the Q&A, and I will give you the email to send the email to about the missed polls so we can ensure that you receive credit. So I do apologize for that, if that answers anyone's questions or concerns.
Yeah, here, let's, while we're waiting, there's some good questions here. A rec district is having a city operate its pool and parks. The city keeps all the revenue and turns over. How would this arrangement be categorized? Well, Good question. Now, if the rec district is within the city's reporting entity, it's just a due to, due from. Now, if the rec district is legally separate, not a component unit, and so on, which is common in places perhaps like Illinois, that could be a P3. And again, it could be revenue sharing, could be a service concession arrangement, which I've found a lot here on the East Coast. So yeah, that could be interesting. Let's see what else. We have conduit debts with no commitment. Our note disclosure includes the description of the debt. For our case, we do not need to change our note disclosure. I take a look at your note disclosure and just try to align it, sir, with GASB 91. But that's a very good question. If indeed you are a conduit debt issuer, you may not have any reporting at all. If you're a conduit debt obligor, yes, you may have reporting. All right, so we're up to 88%, I think.
Yep, we are. Everyone, please make sure you answer your question that's on the screen. You can answer it right from the screen. Please do not answer the question in the Q&A box. Answer the question, and then if you don't see the submit button, just scroll down a bit and it should appear after you select your option.
Somebody asked, what would a water authority be considered? It could be a component unit. It could be legally separate. I've seen some private water authorities. It really depends on facts and circumstances, sir. All right, should I advance my?
We'll give it another couple of seconds. Everyone, if you missed any polling questions, please make sure you do answer these questions. All right, and we are good, Eric.
All right. So yeah, I mean, I think really, you know, these should be fairly well known in terms of P3s. I'd say the largest governments, large municipalities, counties, definitely states, they probably have some form of P3 that's out there. So just take a look and see what you got. Okay, Nathan, for the standard we all have known and came to love, and we paid our price of admission for. Take us through GASB 96. Thank you, Nathan.
Okay, thank you. All right, GASB 96. GASB 96 establishes accounting guidance for your subscription-based IT arrangements, also known as SBITAs. So as you will hear throughout the segment, the key is what is in the contract. Some of these software packages may or may not be in scope. It really depends on the language. We will go through more examples of SBITAs in a second. So this is just to get us started. There's no prior guidance for SBITAs, but it is effective for this year. The most common models of SBITAs are on the screen, and we will go through some examples shortly. All involve your government using software, hardware, or a combination of the two in a subscription or license fashion. This arrangement is commonly known as cloud computing, but it is so much more than that. As an example, if you lease a vehicle these days, some of the elements of the vehicle's operations may be subscription or license-based, including over-the-air updates of the software that manages the vehicle. These contracts commonly have multiple components, including maintenance, upgrade assistance, and many other potential elements. Depending on the contract language, the SBITA may result in an asset and a liability, or it may just be an outflow. Each contract is different and must be read, understood, matched to the elements of GASB 96 and implemented. Here are some examples of the more common SBITAs out there by type of arrangement. I am sure you can name many more. These are the ones we have commonly seen. So for example, you have SaaS, SaaS arrangements, Office 365, IaaS, such as Oracle, PaaS, Apple iOS and Amazon Web Services, Snowflake, for DWAAS. Again, you'll have others. You will have others. These are not the only ones. Further, you may have a mainframe as a service contract, which is a combination of all the pie slices. We have seen a few of those. What is a SBITA, though? Under paragraph 6, a SBITA is defined as, and kind of a quote here, but it's a contract that conveys control of the right to use another party's IT software. That includes IT products such as SaaS, infrastructure as a service, and platform as a service alone or in combination with tangible capital assets as specified in the contract for a period of time in an exchange or exchange-like transaction. So as you can see, this definition mirrors the exact definition of a lease under GASB 87 with a few exceptions focusing on IT software alone or in combination with tangible capital assets. The IT software is intangible, but as you can use it alone or in combination with a capital asset. Now, there are some exceptions, and I'll get over those in the next few moments. All SBITAs are, by definition, a lease. In practice, many of the contracts we have already reviewed are titled lease. The scope of GASB 96 has some exceptions, some of which are on the screen. If the SBITA is purely a tangible capital asset with no software, such as a server with no software, that is a lease. Your government will follow the existing lease guidance. If the contract is the opposite, no hardware, all software, follow GASB 96. And then if it's a combination, but the software is insignificant, which generally means less than material, but more than trivial, follow the leasing guidance. Otherwise, follow GASB 96. One of the sticky points of GASB 96 is it only applies to the end user, whomever signed the contract. This is tricky for many governments, such as states, public colleges, universities, and hospitals that have one department that signs the lease agreement, but others who use it. There is also no guidance for the handful of government vendors out there, including one of our clients in Colorado. There are many contracts that may indeed be short-term. However, they are not automatically excluded, as we'll need to inventory those contracts for audit purposes. At the other extreme are perpetual licenses, which do exist, and we'll talk about those in a bit. The project we are doing includes gathering all contracts that may be in scope, and then based on the facts and circumstances as of the beginning of your fiscal year, determining if there is an asset and or a liability that needs to be recognized. In some situations, there may not be a liability, but there will be an asset. For your information, here are the debits and credits that will need to be recognized as part of the project and forevermore with the contract. Like the related standards to GASB 96, each contract will need to be reviewed with your government, determining whether the contract is in scope or not, and then implementing. So on this and the following slide are a checklist in the form of a project plan. This includes the following steps: gathering the contracts that may or may not be in scope. Some contracts may be purely fee-for-service arrangements, while others are long-term arrangements for a combination of hardware or software. Step 2, contracts then need to be matched to the definition of a SBITA to determine if the contracts are in scope or out of scope. 3, then the term of the subscription needs to be calculated. Depending on the language of the contract may be 12 months or less, while other contracts are longer. Some contracts have options to renew or terminate. 4, From that information, the next step is to calculate a SBITA liability, if any, based on the term, the discount rate in the contract, which is based on your government's incremental borrowing rate, or if your government is not a frequent debt issuer, a policy determining what your borrowing rate might be. We may need to note if the rate, additional licenses, or license terms change within the contract, potentially triggering a remeasurement. 5, the next step is to determine the asset side. Easier said than done, as many licenses may have one payment retiring the liability or may have upfront payments. In the case of a large system, large systems also have implementation costs and other elements. So 6, some contracts have combinations of mini licenses, pieces of equipment, or seat licenses within the contract. The contracts may also have various elements beyond the licenses or subscriptions within the contract, including training, subscriptions, training, conversions, upgrades, maintenance, and support, and many other elements are possible. These all need to be identified. So step 7, some contracts identify when modifications and terminations may occur. In some contracts, there is planned obsolescence, which factors into the term calculation. And then finally, the last aspect is to draft the note disclosures relating to the work, and the disclosures will need updating annually. So the GASB is releasing a clarifying questions and answers over the next few days, 2 of which are on this and the following slides. The first is extremely common. Many of your government's licenses are likely for 1 year, and they automatically renew unless you tell the vendor you do not want to renew. So a common example is Office 365. Does that mean that your government owns Office 365? No. The renewal piece is an option to terminate at every renewal date, usually annually. That is not a perpetual license, which we'll talk about shortly. Since it is not a perpetual license, it might not be an asset, but since it is an option to terminate, GASB 96 has language describing a short-term SBITA. At the start of your term, the contract has a maximum possible term of 12 months or less, including options to extend without regard to the probability of extension. It is short term. If a government and the vendor have an option to terminate without permission, or if both must agree to extend, they are cancelable periods. Many contracts we have encountered thus far are rolling year-to-year contracts, and since those are cancelable, they are short-term, which meaning they are expensed, not capitalized. Does this mean we just disregard them? No. We still need to inventory. We need those for inventory purposes to support the audit. So what is the opposite? That would be a perpetual lease. Such licenses have no dates in them. Your government can change the code, you own the code. But does that mean that any upgrades are your expense and at your peril? I have seen some licenses that do have a change in ownership and full access to functionality. It really depends on the contract, but perpetual licenses do exist, and in those cases, an intangible capital asset exists as well. Another clarifying question is included in the scope of GASB 96 with the various service platforms that we described earlier, all commonly known as cloud computing, and the guidance wants us to review the contracts, match the contract to the scope of GASB 96, and determine if a SBITA, if it is a SBITA based on the contract. So as you've heard, the contract inventory is key, and we will find surprises, including multiple contracts with the same vendor for the same SBITA, but signed by different personnel. This will then show some internal controls that may need to be updated, including who can authorize contracts, extend, modify, or terminate contracts. As major systems, are we recognizing the resulting asset properly to determine what is expensed, what is capitalized? Is the result in the resulting asset, if there is obsolescence, are we recognizing that? Now, some SPIDAs have multiple phases or waves, typically enterprise resource planning or ERP systems. Many of these are multi-year contracts and many require upfront payments. They are complex. There are three overarching phases of these contracts. There's the preliminary, application and development and subscription, and operations phases. So what is in these and why does it matter? Any operation prior to where your governing body says, okay, proceed with the project, here is some funding, all of those costs are expensed. The biggest being project management, startup costs, RFP costs. Those are expensed as your government may not be sure of going forward. The second phase is design, code configure, test, and initial conversion of the infrastructure to go live. In almost every contract that I've reviewed, there is a specific definition of go live. Most costs prior to then are part of the asset. After that, after go live, expensed unless the costs add an asset such as new functionality. And the third phase is stabilization and operations. These costs are expensed, most notably training and conversion of legacy data that is not needed or archived. As on the screen, these costs are expensed. Hopefully you will see that the asset side is a little more difficult than the liability. Here is a typical SPIDA. And this and the next slide are two tiny pieces of a 238-page contract that is a real SPIDA. This is for a VoIP system, network, security, disaster recovery, software, hardware, consulting, and many other activities. This contract also has payments in advance. In this case, 60% was upfront at a particular milestone, which is common in SPIDAs. Overall, the project had a 7-year term with 1 full year to build, which that term far exceeded $1 million. There were so many elements in the contract it would be hard to present here, but the activities fell into 8 categories that are on the screen. Since the payments were up front, what do you do? For this SPIDA, you have a right to use asset at the point of go live, but no liability as it has been paid. Now, there may be some ongoing maintenance of the software cost, and if the maintenance is aligned to the SPIDA period, it is a component. If it is less than the period, it may still be a component, but remember the discount rate may change just like a lease. This could also be a combination SPIDA with multiple locations. So the journal entries for such upfront payments are on the screen. Once go live is met, then a liability exists. So let's talk further about the process of implementation. The first thing to do is evaluate your current subscription-based IT arrangements, accounting, and management processes. Centralization of SPIDA records would be, think of that as step one. You want to understand what you're doing with your SPIDAs. Who is booking the SPIDAs? Are they centralized? Is it only going through multiple departments? You want to start pulling those records together. And then 2, evaluation to determine scoping within GASB 96. And this goes back to the scope of your subscription agreements, evaluating how you will account for those. Do the contracts consist of only IT software or both software and hardware components? And which guidance to apply? Understanding processes for new SPIDAs. And now that you're aware you will account for the SPIDA, it will be best to create or make processes for new SPIDAs so that going forward, your accounting department is notified and can evaluate for those going forward. Essentially, understanding your current processes and having solidified moving forward. So there are likely internal resources in managing your IT arrangements. Since you've already implemented GASB 87, you know that multiple departments are involved, including the legal and the accounting department. Getting those departments up to speed and aware, educating those departments if they are involved. Be aware of any internal control limitations. Whatever you've done for GASB 87, you'll do for GASB 96 today to implement. We can have you in compliance with both within the software. So one problem we are already seeing in decentralized governments, multiple departments may be able to sign a license contract. Be aware of anti-piracy laws in your state and of signing contracts for the same software in multiple locations. They are inefficient and could cost precious funds. Most SBITA vendors offer quantity license discounts, and by obtaining multiple license discounts, there is a way to control logins as well. Inventory is important from an accounting and reporting aspect and from compliance with laws and regulations. We know that due to many states that have anti-piracy laws, or in the case of one state, anti-TikTok laws, if you do not have a concise, updated inventory with licenses, you not only have a recognition and completeness problem for accounting purposes, but you may have a compliance problem. Speaking as an auditor, I know the focus is going to be on the completeness of the inventory as it was with leases. Once the inventory is known and reasonable with scope exceptions documented, then recognizing the assets and liabilities just that falls into place. Presentation and disclosure and compliance aspects will also likely be part of the audit. Let's think further about that team. As you have heard today, SBITA may touch on a wide array of expertise needed. So you may need accounting folks, the controller team. They do the debits and credits, internal audit, search for contracts, treasury and finance, discount rate discussions, systems, inventory, legal, contracting, anti-piracy, the purchasing folks on the contracting side, governance, decisions relating to policies, procedures, discount rates, impairment, and so on. Again, the focus areas in the audit are likely going to be on the screen. Completeness is key, followed by the rest, but do not forget compliance. So do not just do a search for all contracts that say the word subscription in your database. Some contracts use the word lease. Furthermore, we have the problem of combinations and components. Some SBITAs may have both hardware and software. Remember, if the software is insignificant, it's a lease contract, but we need to know that. Some of the key policies and procedures are the same as leasing, but those policies and procedures need to be expanded for SBITAs. You may be surprised in your government who is signing contracts without signatory authority. It's easy to download an app without controls and then get billed for it. The required note disclosure is the same for SBITAs as it is for lessee contracts in leases. But make sure that your capital asset footnote has a separate subsection for right to use leases and SBITAs. nearly every aspect of the lease note is the same otherwise. Furthermore, there's no need to insert a line in your debt roll forward schedule for submittals. And with that, that leads us to our next polling question. So what do you think? In my estimation, the most important aspect of implementing GASB 96 may be. Give you folks some moments to think about that one.
Well, thank you,
All right,
Nathan.
everyone.
Thank you, Maya.
Remember, if you did miss any polling questions, please make sure you are answering these polling questions, and the requirement for the 2-hour webinar, you would need to stay on for 110 minutes, and you do need to answer all 7 polling questions. And if you have any issues with answering the polling questions or anything about your screen or browser, please let me know in the Q&A box, and I will give you an email to send the issue to, so we can ensure you received your credit.
Okay.
Here, I'm taking a look and see. We got some questions going back to P3s, but here's one. We use a entity, but we sign a contract with our county office. They have the main contact, but we sign a contract with them to use. Do we report, or does the county office have to? Good question. And that is a common problem that we're running into. And actually, GASB knows that there's a hole in the guidance as to, let's say you have a county office or a state office or even another state that is signing, say, a master service agreement or a purchase agreement, and they happen to be signing an end user license agreement, but then they're charging you as part of an internal service fund, on that. Well, I think on that one, you gotta look at who is the end user license signer, and it's stipulated in the contract. And whoever is that entity that signed the end user license, they're the ones who are going to be holding the liability. And I wish it could be more definitive, but these contracts are going to be different for every single entity that's out there. Now, here's another one that's similar. We're parties to SIBITAs where we are listed in an appendix as a party, but our parent organization signs the contract. Well, that's the same thing. We have a management agreement and so on. Yeah, I mean, again, whoever signed the contract as an end user has the liability. Whatever arrangement you have with a parent government, say the primary government, whatever arrangement you got, that could be a due to, due from, or an internal service fund payment, or a usage license, or something like that. Nathan, what do you think on that one? Yeah, you're on mute. Yeah. Yeah. What do you think?
Through.
Yeah. What do you think on that one? Hey. And it's okay, we can skip that one. Here's one somebody works for a university, which is a component unit of the state. The state has master agreements for vendors and software, but the university pays for its licenses. Would we have to record the SIBITA, or the state record them? And again, I think that unfortunately, I can't be more definitive, but if the state signs as an end user, then it has the liability. If the university signs as an end user, then the university has the liability. I mean, what do you think, Nathan, on that?
Yeah, I would go signer of the contract. That's the party with the legal obligation. I would expect the party that is calculating these things and potentially presenting those on the financials.
Yep. Good idea. All right, we'll get to the others, and again, we're headed close to 90% up there. Yeah, documenting inventory. I mean, that's why we hit it really hard. I mean, I haven't seen the state and local audit guide come out yet, and maybe it has. I didn't look this morning, before the webinar, but if it has come out. Has it come out, Nathan?
Oh, that I haven't seen. I would just say I do think the hardest part of the implementation is inventory your listing of what's out there. That's what we found with the leases. Once you
Yeah.
have the contracts, once you have the terms laid out, then the rest of it is there's some judgment, but a lot of it is math.
Right. Right. I tend to
Coming up
agree.
with that inventory
Yep.
and then being able to survive the audit questions.
Absolutely. Well, thank you, Nathan. You've done a great job. And so let's talk about a quick recap of GASB 99. And I know one of the first questions was on GASB 99. And let's, I guess, talk about some changes that we need to understand due to GASB 99. And the first elements of GASB 99, they should have been already implemented as they were immediately effective. And, I was in a state auditors meeting last week in Hartford, Connecticut, and we talked about disclosure of non-monetary transactions. There was a hallway conversation about that, and that was kind of interesting. And frequently, it's sort of the mongrel dog of GAAP. We've overlooked those because for generations, those transactions have been netted. Well, now we got to disclose how we got to the measurement of the asset side. Again, it might not be material as we're going to swap one building for another or a sheriff's car for another. Might not be material, but we got to disclose how we came to the decision that it wasn't material. Now, there are other things that you may want to consider, and if you have some of these, just sort of reach out. The LIBOR link is pretty important. For those of you with mortgages with LIBOR, including me, my home mortgage is linked to LIBOR, and I got a letter 2 weeks ago from my mortgage bank saying, "Hey, we're doing away with LIBOR, but nothing changes in your mortgage because your mortgage doesn't sunset until 2032." Okay, then why did you send me the notice that it's going to change to a SOFR in 2032? By my watch, it's 2023. I really don't care. But they already sent that because LIBOR is going away. And so if you do have contracts that are in LIBOR, just understand what's going on. And there's some clarifications that the GASB needs to do just to clean up its own documents. And those are at the bottom of the screen. Now, this is a good cheat sheet of what is in GASB 99 for 94 and 96, which we talked about earlier over the last hour or so. Now, there are some provisions that are just not applicable in 94 and 96, but all will be implemented this year. And so let's focus on the key issues and how they're going to apply. The first piece is on the option language to terminate or purchase. And again, an option to terminate, that's an unconditional right that exists within your contract. In a provision that gives either party the right to terminate only in certain circumstances or upon the occurrence of certain circumstances, such as the action or inaction of the other party to the contract, meaning they didn't pay or they did pay, that's not an option to terminate based on trying to figure out what the term is in the lease or in the CBITA or in the P3. So, for example, provisions that allow terminating a P3 due to a violation of P3 terms and conditions, such as when the transferor defaults or the operator defaults, they're not considered options to terminate the P3. And so these are just really clarifications. The short-term calculation also has a little wrinkle in 99, but only applying to CBITAs, as P3s are unlikely to be short-term. There's, again, no way you're going to get to there. Now, this is a big deal as it may represent the closure of a huge loophole that may have allowed a lot of short-term leases. But here's the kicker. A CBITA that previously had been determined to be short-term and that has been modified to extend the initial maximum possible term in the contract should be reassessed from the inception of the contract. if that reassessed maximum possible term is greater than 12 months, now that contract may no longer be a short-term SIBTA. Again, you gotta modify those original terms. And the reassessment would be from the date of the modification, but for this year, you might as well go back to the date of implementation, because again, we're still in the implementation year. Now, for recognition and measurement, GASB 99 clarifies what is already in an implementation guide question. No, you do not need to remeasure the assets and liabilities just because the index or rate changed, which is great news because, 19 months or 2 years ago, we had mortgage rates in the twos, and now we got mortgage rates in the fives, sixes, and sevens. But you do need to change if that change also includes an adjusted term. Now, this also impacts receivable calculations, but only for P3s. Now, this is another piece that was also an implementation guide question, but now they elevated it up to a standard. Incentives also include the assumption of existing leases. And you're going to find this really prevalent with commercial real estate where landlords are begging for tenants. It made the front page of my morning newspaper here in Boston that the commercial district in downtown Boston, landlords are routinely doing this where they're saying, we will assume your existing lease. And if you move out of that existing space and move into the space that we happen to have for you, the landlord pays off your old lease, and that is an incentive. And so if you do happen to have this situation going on for leases, P3 is unlikely, SIBTA is unlikely, well, maybe. It is just an incentive. So to put all this together, here's a cheat sheet of what is included and which standard applies. And again, you may want to keep this handy. So guess what, folks? That's about it for this year, for this June 30. Okay. But we need to, for GASB 99, we got to look to next year. There are two additional areas and one subtle change in GASB 99 that you may have missed. First, some of us know and love GASB Code Section N30 on GASB 70 on non-exchange financial guarantees. Now, these are when another government backstops debt just in case there are issues in repayment. And these are usually one-way transactions where there's not quite equal value for value. And, when I was a state in the state treasury, we called these contract assistance. When I was a CFO, what happened was the state stepped in and paid if somebody didn't pay their debt service on a particular series of debt, bonds. But again, that's sort of a guarantee. But built into GASB 62 way back in 2010, there was a tiny provision for exchange and exchange-like financial guarantees. To my knowledge, nobody's ever used them. But the GASB found a handful of these going on. Now, my own personal opinion, when someone is paying me in an exchange for a guarantee on their debt, that does not pass my sniff test. It doesn't sound right. It kind of sounds kind of nefarious, in my opinion. But GASB is now expanding the guidance for non-exchange financial guarantees to exchange and exchange-like financial guarantees in GASB 99. So effectively, the change goes to GASB 70. But for those of you who use the codification, like many of us do, the old codification section N30, it disappears. And we're going to have a brand new codification section F30 that is going to take over for that one. Also in GASB 99, there's an expansion of derivative instrument guidance. And in this case, the derivative was supposed to be a hedge, but the hedge became ineffective, likely due to a movement in interest rates. Not like that's not going on. Now, given that the instrument is not for income or profit, indicating an investment derivative instrument, a third category of derivatives was needed. Now, back when the derivative standards were being thought about and I was on that task force back in 2001, we thought this would never occur because interest rates didn't move like they did over the past 4 or 5 years. Now, this is going to result in a new category of hedging derivative instrument, and reporting and note disclosure are going to be separate from hedging derivatives. A termination of the hedge did occur, and in that case, a gain or loss is going to be recognized. And again, we didn't contemplate this in what became GASB 53. Now that they do occur, in this economy, GAAP needed to be updated. And so I'm not sure it will affect many of you because many of you may not be allowed to do derivatives, but just in case, there is that situation that is going on. All right, so let's dive into next year. So, okay, GASB has hit the century mark with accounting changes and error corrections. And before you get upset at GASB for hitting the century mark, our fellow standard setters in the auditing world, I think they're up to 147 or 148 or something like that. So the GASB is still trying to catch up. Not that they will. I don't. Certainly not in my working lifetime, but you never know. The GASB. The GASB 100 is on accounting changes and error corrections. Now, this changes pretty much middle-aged GAAP that existed prior to the GASB and was absorbed into GASB GAAP with GASB 62 back in 2010, and it hasn't been changed. Many of the provisions in what we're doing in accounting changes and error corrections, they stem from FASB 16, which was issued in 1971. Yeah, 1971. Now, the three types of accounting changes are still there. And oh, by the way, FASB 16, it was just an absorption of old AICPA standards. Now, the three types of accounting changes are still there with one major change in red. Changes to or within the financial reporting entity. And then the error correction provisions are clarified to what I think may result in better reporting and from a transparency point of view. So let's go through the changes, including some potential myths that I may bust. Changes in accounting principle are changes from one GAAP standard to another that is preferable, but both are acceptable. So they got to both be acceptable. Or it's when GASB requires a change due to the issuance of a new standard. Now, to be preferable, you have to hit one of the provisions on the right. And again, there must be two existing elements of GAAP. So, for example, going from the weighted average maturity to a segmented time distribution disclosure and the investment risk disclosures. That is a change in accounting principle. Now, to bust some myths on this one, a change in accounting principle does not occur on any of these on the screen. So in deference of time, just keep this handy. These are big, big no-nos. Don't do it for a first time a transaction occurs. Don't do it going from a non-GAAP transaction to a GAAP transaction. That's where you messed up. And no matter what. So that's an error. All right. So what about a change in accounting estimate? Well, we know and love these and we can't live without these. These are all through our basic financial statements. Lots of stuff is based on assumptions and uncertainty. And changes occur with new data, new experience, and so on. And your most common change in accounting estimate, that's probably going to be related to your capital asset useful life, or it may be some form of investment valuation change that you do, or change in a receivable in terms of allowance account or something like that. These occur all the time. Now, here's the kicker, and I know we're heading towards the tail end of our program here, but this is the one where you go, uh-oh. Now, GASB added accounting changes disclosure to changes within the financial reporting entity. Now, before we toss all of our badges onto the fire, let's wait a minute. I wonder what's going on. There's a helicopter outside my window here, and it's been hovering for a while. Now, what we're talking about are changes in component units, adding a fund for current operation, not a new fund for new operation, and changing from, guess what, folks, the major funds to non-major funds or vice versa. So again, what we're talking about are changes in component units, adding a fund for continuing operation and not a new fund for new operations, or changing from major to non-major or vice versa. But don't include acquisitions, mergers, or transfers of operations that result in the addition or removal of a discretely presented component unit. Those will not be included in the changes to or within the financial reporting entity. Also, don't include a component unit reported in accordance with majority equity interests as part of this category of change. And this is under GASB 90. Now, there could be situations where a change in accounting principle may result in a change to or within a financial reporting entity. Now, for disclosure purposes, these changes would be a change to or within a financial reporting entity. So these changes could change some of the disclosure you're long have gotten used to. Now, GASB is going to be clarifying these changes within a reporting entity in the upcoming implementation guide update. The board voted this in last week, and so it's in the process of publication. Watch your inbox. It'll probably be posted on GASB's website by the end of the month. In this question and answer, the government closes out a major capital projects fund as the project is done. The resources left transfer back into the general fund. In this case, it's not a change in reporting entity. It's just a transfer in and transfer out, kind of like what we've been doing all the time. Okay, so then we got the biggie, which is error corrections. You know what it is. You had a brain cramp. Most of these are GAAP interpretation errors, line errors, what I used to call fat fingering, because my fingers were fat and you pushed the wrong key and so on. I've done them. You've done them. We've all done them. We got to get over it. Yeah, we made a mistake. It's not fatal. It's not gonna, it's not going to shut down your government just because of that mistake, although there are some serious mistakes that are out there. Now, due to the differences, different GAAP and GASB 100. Notice that changes in accounting principles and estimates are similar to what we do today. Now, changes in financial reporting entity, they're going to require an adjustment of the beginning balance as if it occurred at the beginning of the year. But there's a major exception. If that change in financial reporting entity is just the change from major to non-major or non-major to major, that's an exception. But every other type of change in financial reporting entity, that's going to trigger note disclosure. And finally, error corrections, those are the same as current GAAP. Now, remember, if you have comparable financial statements, meaning 3 years of MD&A, 2 full years of basic financial statements, 2 full years of note disclosure, you got to go back to the earliest period presented on it for those changes. But wait, there's more. Guess what, folks? There's going to be no more asterisking a row or a column and then saying, yeah, it's been restated. You'll need to include the restatement on the face of the financial statements, and we'll show you how it's going to work in a little bit. But yeah, there's going to be a different way of doing things. We've all made that note disclosure. Certain amounts were restated in prior amounts to conform to current year presentation. I've done it. You've done it. Those days are going to be over. Okay, what's this all going to look like? The note disclosure again is going to change. Keep the screen handy as you implement the changes and error corrections. For changes in accounting principle and estimates, similar note disclosure will be required, but for principal changes where you're going from one existing GAAP provision to another, you have to disclose why the new provision is preferable. And of course, since you're going to be disclosing that why, guess what? Nathan and his folks, they're going to be auditing it. So you got to disclose why things are preferable and try to be as succinct as you can. And again, another change that I kind of like is this removal of the boilerplate language that certain amounts were reclassified to current presentation. That's going to be gone. You're going to need to list the line items that are changed and why the change is preferable. Now, it could be that you're going through a reorganization and you're just going to do it like that, and that's fine. But just list that as part of those changes. But wait, there's more. There are provisions, in my mind, finally, to restate required supplementary information and supplementary information. This one's been a bone in my side for many years. Remember, we're talking MD&A, pension and OPEB schedules, budget comparisons, modified approach, claims development for risk pools and for ACFRs, introductory and statistical sections, along with combining and fund schedules. Not like there ain't any errors going on in those. Of course, there are errors that are going on. Now, for periods within the basic financial statements, restate RSI and SI as applicable, including the MD&A. For periods outside the basic financial statements, don't go back to prior periods, including those statistical sections in the ACFRs. Just focus what is on the basic financial statements. The inconsistencies in the RSI and SI, they may need note disclosure. For the MD&A, you can refer to the note disclosure and explain the change. But if there are error corrections, restate the periods impacted if it is practicable. If you cannot restate, the schedules will include note disclosures, and you got to explain why it's not practicable. Meaning, you just didn't have meaning you can't put down, oh, I just didn't have the time, didn't have the staff. You got to explain why you couldn't do it. So here's what the note disclosure may be. It may be small on your screen, especially if you're looking on this on an iPhone. So you have this in your handouts. And it's also straight ahead from the GASB. And here is, one version of the schedule of change. I kind of actually like this. It does your government-wide, your governmental funds, proprietary funds, fiduciary funds, and your component units, and it's your previously reported, all your changes, and your as restated. And here's another way to view it where it's more aggregated. I actually kind of like the former one a little bit better, even though it takes up more real estate. And with that, here is another polling question for you. And I know we're headed towards the clubhouse turn here, so in honor of the Belmont Steak.
Alrighty, and everyone, again, if you have missed any polls, please make sure you answer this polling question, and then we have one more coming up after this before the webinar ends. And if for any reason you missed polling questions or you had any issues with your screen, please let me know in the Q&A box so I can let you know how to get that message over to the back end so we can ensure you get your credit.
Yeah. All right, so let's go right here. Let's say, yeah, it's a thorn in my side. Who knows? Can you expand on adding or removing a fund for continuing operations within the government? Okay, so let's say you have one federal grants fund, but you had second thoughts and you want to have separate grant funds for different types of grants. That is going to be that's going to be something from continuing types of operations, I think. Is there a link to LIBOR on slide 72? No, it's not a hot link, but it's embedded within GASB 99. There's a lot of questions here. I love it. We may have to do these by email. We can get to these by email, right, Mai? Just in case.
Yep, not a problem. So if there are any questions left at the end of the webinar, I can pull the report for you and send it to you. And you can answer all their questions and email it directly to the participant.
Yeah, so we gotta head toward the finish line here. Let's see, because we're getting tight in terms of time.
All right, everyone, please make sure you answer this polling questions. We'll leave it up for a few more seconds and then we will continue.
Come on, folks, click.
All right. And even though it may say that you have completed all the polls, remember that is a glitch and you do need to answer all 7 polling questions. If you've downloaded your certificate and it says 1 hour, please send an email so we can make sure we get that fixed for you and send the correct certificate that shows 2 hours. So please make sure of that if you have downloaded your certificate early. You can wait and hold off and not download your certificate right now. And then when you do receive that thank you email, please advise in regards to your certificate saying 1 hour and we can get the correct one sent to you. All right, Eric, and you can continue.
All right, let's see. Yeah, I mean, errors do happen. I mean, Nathan, in your practice, I mean, yeah, we see these a lot, you know, beginning balance adjustments and so on, you know, I mean.
All the time.
Yeah.
And as we march towards more GASBs, these things only get more complicated.
Right. And so, speaking of getting complicated, you know, let's morph over into GASB 101. And some of you may say, you know, GASB needs to go back to GASB 101, and that's a joke, but you know, so this is so you can get ready for next year. This is not something you need to drop your, you know, pencils right now, but this is just to give you a sense of what's gonna happen. Now, this was another standard that needed to be updated as it's nearly 30 years old. And just to give you a sense, when I started off in this business, my first standard I implemented was GASB 14. And so this was right after it. And now we're at GASB 101. We're about to have GASB 102. And I'm not pulling the H card. It actually kind of depresses me, you know, that I've been around for this long. But what's the matter with the old GASB 16 is the conceptual framework for GAAP we use today is so much different than when the original standards were released back in the early 1990s. And benefit practices have changed, and as we all know, working conditions have changed. And as we all know, current GAAP was very disjointed back then. You know, 2 acceptable calculation methods are currently used for liability related to compensated absences, and that leads us to inconsistencies. And then there's the note disclosure. You know, the note disclosure, it really doesn't make a lot of sense. You know, I've prepared so many note disclosures on compensated absences, and I got to tell you, none of us know how much we actually use on compensated absences or accrue on compensated absences. You know, the pluses and minuses, none of us know how much they really are to the penny every single year. And so, yeah, this needed to be updated. The basics of compensated absences are only slightly updated. We're still considering leave for which employees, not retirees, receive cash when leave is used or when termination occurs. Compensated absences still may include non-cash conversions to OPEB, and that is really, really common. Now, there are 3 phases in calculating the liability. Just like any other liability other than in the year of conversion, we start with what we left, where we left off in the prior year. We add the current year services that have accumulated additions to the liability. And then if the absence is more than 50% to be paid, now this is where the difference is, we're going from probable, which is under current GAAP, we're going down to more than 50%. We're going to that more likely than not. That's what's going to cause a swing in liability. And then, of course, the third phase is settling things out where the liability is actually retired. Now, there's an exception, though. Leave that's irregular is not counted in the liability until it's more likely than not to have occurred. And this type of leave has skyrocketed since GASB 16 was issued. We're talking parental leave, jury duty, disaster leave, and so on. Also, unlimited leave has risen, especially during the pandemic. Until that leave has occurred, it's excluded from the liability. Now, for large governments, the measurement of the liability will be pretty difficult, but it still involves that basic three-step process of measurement, multiplication, and adjustment. Now, due to the lowering of the probability threshold from probable to more likely than not, unless non-cash settlement occurs, the liability is going to change. Once the hours are known, the dollars must use the current pay rate unless it's known that the settlement will occur at a different rate, and the difference is usually in a collective bargaining agreement or something similar. Now, there are adjustments, and those include payments that are either directly or incrementally related, and they include Social Security, Medicare, or defined contribution, not defined benefit, defined contribution payments that are based on hours earned. All of these are then summed up to develop the liability. Now, some governments are increasing the use of shared leave pools, especially for catastrophic illnesses. If the leave is not attributable to a specific employee as of the financial statement date, the measurement of the liability uses the rate representative of all employees. Now, back when I was a deputy state controller, we used a shared leave pool. And so that was 13, well, close to 14 years ago. And so I'm sure you may, have this for, obviously folks who unfortunately have a catastrophic illness. So again, use the rate that is representative of the entire employee population. The board did not stipulate an average, but one can imagine an average or a median, and then you disclose that process. For liability settled with non-cash means, just use the amount that is more likely than not to be settled as the amount recognized. And so I betcha you're probably going to say, okay, what occurred from July 1st to August 31st? And yeah, that's my more likely than not. Now, I'm not going to tell the auditors on the call, but I bet you that's probably what you're going to do in practice. The note disclosure may be easier than today once you implement GASB 101. Again, the beginning and ending balances are still there, but now you got a choice. You can still do the increases and decreases, or you can present a net amount as long as in the text below the table you note it as a net amount. Now, gone also is the disclosure of which governmental fund will pay for the liability. This made no sense. It is pre-GASB 34 GAAP. The board said, take that out, get rid of that. And I think for those of you who really want to see the mechanics of how this whole thing is going to work, come back to us in the fall. We're going to probably show it as part of our year-end webinar. And we may run through a real example with you. And so just be aware that this is out there. All right, really quick. This leads to our breaking news of what will be GASB 102, certain risk disclosures. This is almost final, but not quite. And so it is probably going to be out by the end of the summer. This is going to be an assessment of your government's current vulnerabilities due to certain concentrations and certain constraints. Now, you may already be disclosing the principal employers if you prepare an ACFR, and because those are in your statistical section, and you can infer resource providers or inflows from other tables in your statistical section. Now, vulnerabilities on debt limits and raising revenues and spending, you might disclose those already, especially if you have tax caps and things like that. And the GASB understands that these are existing disclosures for many governments. Now, disclosures may be required if there are risks that have a substantial impact if they occur, or will more likely than not begin within 12 months of the date that the financial statements are available to be issued. Now, what does the word substantial mean in GAAP? Well, GASB does not have a succinct definition, but it suggests more than significant. Okay, so again, we're talking about the word substantial. It's more than significant, but then what is significant? Well, then GASB staff put this together about a month ago for a presentation, and still no real definition there. We know it's not remote, reasonably possible, maybe. It could be more likely than not, but less than reasonably certain, which is what we use in GASB 87, 94, and 96. My guess is significant will be similar to probable, which is what you use for claims and judgments and compensated absences as of today, prior to implementing Statement 101. Now, what is going to be required in the notes? And again, this is still moving in pieces a little bit, but here's what's probably going to be in a checklist, including the concentration or constraint, if it has occurred, what your government has done to mitigate the occurrence, and so on. Now, so far, only do this for the primary government unless the risk is specific to the reporting unit and then has a substantial impact on that unit. But the GASB is still working on that language. So here's where we're at with Statement 102. The final vote is coming in August. And that said, right now, unless changed later on this month, the implementation date could be in fiscal 24, but we're going to see what occurs. I'm not sure. Don't take that to the bank. What was proposed was June 15 of 23, but we're not sure if that's actually going to go forward. With that, what do we think on our polling question? And that gives us a chance to take a look at this thing. Somebody's phone's ringing.
All right, everyone, this is our last and final polling question. So if you have missed any polling questions, please make sure you answer this last and final polling question. And again, if you missed any polls or you had any technical issues in regards to your screen freezing in the middle of the webinar, please let me know in the Q&A box so I can give you the email address to email in regards to the issue. And we do have a few more questions, Eric and Nathan, if you want to take care of one or two while we're waiting for this last polling question.
Yeah, why don't we take care of like one or two? We got a lot of them, and Nathan's
something.
Yeah, what do you got?
SPITA. So if our software agreement initially had a 3-year term, but we are now in an annual renewal time frame, would that be considered a SPITA? I think Eric, you can certainly help me out here, but I think yes, it'd still be a SPITA. You do want to consider, as of the beginning of the implementation period, are you now in that renewal time frame? Maybe be considered short term if at the beginning of your fiscal year when you're doing the implementation, you're in that annual renewal time frame.
Yeah, I think so. I think you're correct. Nathan, you're in one of those year-to-year accruals, and it still have to be inventoried. For my friends in California, by the way, correct me if I'm wrong, Nathan. You got to do an annual filing of all your IT assets to the state. Yeah, and if you're not listing that SIBITA, you might run afoul of that, and that is a state law. I think it's SB 272 or something like that. And so please, include that as part of your inventory, but it may be short term.
Yep, and I think that's going to be fairly common this year.
Yep. And now there was one question in here: how would the discount rate be determined? I'm assuming for a SIBITA. Now that's going to be tricky. And so you're supposed to use your incremental borrowing rate. But if you don't know what your incremental borrowing rate is, you gotta, obviously involve your treasurer or CFO or somebody like that to help you determine it. But you got to remember that a lot of these contracts are going to be a lot shorter than your bonds. So if they're a lot shorter than your bonds, you got to have some form of policy and procedure to help determine the discount rate. I mean, what do you think, Nathan? On that?
Yeah, I think the most important thing, there's some room for judgment there, but the most important thing is just make sure that it's documented so that when the auditors ask the question, how did you as a client, as an auditee determine the discount rate? Here's what we did and here's why it makes sense.
Yep. Yeah. So kind of the same thing for pretty small governments, but remember, we did for pretty small governments for leases. But remember, don't just automatically port over your leases stuff over to your CBITAs because they're usually much shorter term. And I mentioned, planned obsolescence. There might be a built-in upgrade path into a CBITA contract, and I've seen those a lot. And so if there's a built-in upgrade path, you might have planned obsolescence where, they say, okay, we're going to replace this server 2 years from now or 3 years from now because obviously the technology. And the same obviously with software. I mean, those of us who have smartphones, those are being updated, it seems, on a day in and day out basis.
All righty, we
How
have
we
just a few more minutes left. Again, everyone, we can keep this last polling question up for a few more seconds. So far we're looking good, Eric and Nathan.
All right. So let's get this show on the road. All right, because I got something at the top of the hour. All right. So, yeah, excited and ready to go. Not so excited. All right, and ready to get off the hamster wheel of Gap. I feel your pain. Ready to get off the hamster wheel of Gap, but something. We'll all make it through. Let's work. Let's keep working together. With that, I'd like to, again, thank you all for today. Thank you, Mai. Thank you, Nathan, for joining us today. For the questions that we did not get to, Maya is going to put all these together, and we're going to try to reach out to you. Probably by email, reach out to you. I don't think we can post the Q&As, but certainly reach out to your Eide Bailly professional or to either one of us if you do happen to have a question.